In this video, we are going to talk about dividend stocks for cash flow. So before starting this video, please like this video and subscribe to this channel for our future updates. Investing in stocks that pay dividends can offer investors a reliable stream of income over the long run. In addition, the power of compounding can exponentially increase your earnings if you reinvest the income you receive from dividends. About 40% of the overall return that the Standard & Poor's 500 has generated over the past century may be attributed to dividend payments. Every investor dreams of finding the stock market where they may earn huge profits and bigger returns. The fundamental goal of any investor is to profit from the increase in share value. But there are other ways to make money and turn a profit in the stock market. It is discovered to be an excellent and simple strategy to gain a stable and continuous source of income to invest in dividend stocks. The term dividend stocks refers to businesses with a strong track record of paying out profits as dividends to its shareholders. These businesses are well established and prominent in their respective fields. The stocks of these companies have less growth potential than other rising stocks on the market because they are well established and have already reached their maturity peak. Here are the 7 best dividend stocks to invest in. Number 7. First American Corporation. First American Corporation is a provider of insurance for real estate transactions. The company provides a dividend yield that is appealing, in addition to a reasonable annualized average dividend growth rate over the course of the previous 5 years. When compared to the other stocks on our list, FAF has the lowest average dividend growth rate over the past 5 years. The majority of the other stocks on our list have increased their dividends by 14% or more during the past 5 years. However, it has also maintained average annual improvements of about 25% in earnings per share over the same period. This is the strongest earnings growth rate of all the firms on our list. Because it has dropped by almost 30% from its high in January, the dividend yield on the company has received a momentary boost as a result. Because yield is determined by dividing dividend rate by stock price, a high yield corresponds to a stock price that is relatively low in comparison to the amount of dividends paid out. During the past 10 years, the growth of the share price of First American has surpassed the growth of the Standard & Poor's 500 by an average 2.3% per year. That's quite a profitable return. Number 6. Packaging Corporation of America. Packaging Corp is one of the most significant manufacturers of packaging in the United States, with a particular emphasis on corrugated materials and containerboard. It has maintained both a respectable dividend yield and consistent dividend increase on average over the past 5 years. As a result of the current share price being approximately 18% lower than the all-time high that was reached in June, the dividend yield appears to be marginally more attractive today than it would have been in the spring. Over the past decade, the stock has generated annual returns that are 7.5% higher than those of the Standard & Poor's 500 index on average. Number 5. JP Morgan Chase & Company. One of the major financial companies in the United States, JP Morgan Chase & Company offers retail and commercial banking, wealth management, and investment banking services. JPM not only has a respectable dividend yield, but it also has maintained a great rate of dividend increase over the course of the past 5 years. Over the past 5 years, it has managed to increase its earnings per share at a respectable rate of approximately 15% on an annual average basis. Be conscious of the fact that the stock's price has dropped by 35% since October 2021, which has contributed, at least in part, to the current high dividend yield of the stock. Number 4. Extra Space Storage Incorporated. The United States is home to more than 2,000 storage facilities that are owned and managed by Extra Space Storage, which is a real estate investment trust that runs its business. The dividend distribution of EXR has increased at a very healthy rate on average over the past 5 years, contributing to the stock's robust dividend yield. Over the course of the last 5 years, Extra Space Storage has generated a compound annual growth rate of more than 16% in its earnings per share. In the event that this trend continues, dividend increases should continue to be financially viable. The share price has experienced a decline of approximately 25% since reaching its all-time high in December 2021, despite the fact that its performance relative to the Standard & Poor's 500 has been among the strongest on the list. It has outperformed the benchmark index by an annualized rate of 9.6% on average over the course of the previous 10 years. Number 3. Texas Instruments Incorporated. Texas Instruments was once well known for its calculators. However, the company now generates the majority of its revenue from the production of semiconductors and is the largest manufacturer of analog chips in the world. Over the course of the past 5 years, the dividends paid by the corporation have increased at an average annual rate that is greater than 18%. That is significantly higher than the dividend growth of almost all the other stocks on this list. Over the course of the past 5 years, it has managed to maintain an average annual growth in earnings per share of over 17%. Because of the significant increase in earnings, the corporation ought to be able to preserve a dividend payment level that is satisfactory in the years to come. Texas Instruments has fared relatively well despite the turbulent market conditions of 2022, in contrast to the performance of many other technology firms. The share price is currently down roughly 24% from its all-time high in November, and the highest price decrease it has had in the past 10 years is 30%. Hence, it is the steadiest stock on the list. Every other category has seen a decline of at least 37%. Over the past decade, the stock's performance has been 8.8% better than the average annual return of the Standard & Poor's 500 index. Because of this, it is now considered to be one of the stocks with the best performance on the list. Number 2. Lockheed Martin Corporation. Lockheed Martin is not only the most successful industrial stock, but also the largest defense contractor in the entire planet. It manufactures combat aircraft, helicopters, missiles and missile defense systems, satellites, and space vehicles, among other things. Lockheed Martin Corporation now has a dividend yield that is lower than average, and its rate of average dividend growth over the past 5 years is the second slowest in the industry. The stock has outpaced the Standard & Poor's 500 by roughly 8% per year on average over the past decade, while earnings have grown at an average rate of 12.3% during the past 5 years. Lockheed, along with Texas Instruments Incorporated, has fared far better than many other stocks throughout the turbulent market conditions of 2022. Even though they are down more than 18% so far this year, shares of LMT are still up more than 13% from their all-time high in March 2022. Lockheed benefits when there is economic and political unrest on a global scale, like the kind that is occurring all across the world right now. Number 1. Home Depot Incorporated. With more than 2,300 locations, the Home Depot is the largest retailer of home improvement products in the United States, Canada, and Mexico combined. HD is among the most important companies in the consumer discretionary sector. Over the course of the past 5 years, HD has maintained a dividend growth rate of 16.4% on average, making it one of the companies with the best payment growth rates on this listing. HD has easily outpaced the S&P 500 by an average of about 8% a year for the last decade. Annual earnings have increased by an average of nearly 19% over the past 5 years, which is second only to FAF's growth. Shares of Home Depot fell this year along with a general slowdown in both the retail and housing markets. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.